Equity. Have you heard people use this word? Going to use equity. What is equity? How do you use equity? Well, I get asked this question all the time. And today was no different. So I'm trying to put this video together to see if it helps many of you to explain what equity is. Equity is the difference between the value of your home versus the debt that you have against that home. In an ideal situation, you want the value of your home and the debt you have against it to be more than a 20% gap. That's the ideal situation. One, for the banks, they want you to have a good equity gap in there. But two, for you, it means that you'll get a better interest rate. It also means that you will not be charged lender's mortgage insurance. So I'm going to try and explain how we use equity to buy another property. So I'm going to flip my screen around and show you some little pictures because I find that pictures makes things a lot easier. So here we have a couple of different pictures. So the first I'm going to point to is this red home. This is your existing home. Let's say it's worth $1 million in value. And then next to it, the little blue house is the one you want to buy. And that house is going to cost you $500,000. So you will end up with two houses and the value of those homes will be $1.5 million. Then underneath that, you've got your existing mortgage. So let's say you owe the bank $650,000. And on the little blue house that you're trying to buy, you're not going to use any cash. So you're going to borrow the full $500,000 purchase price plus an additional $20,000 to cover the government fees. So the total debt that you're going to be asking the bank for is $650 plus $520 equals $1,170,000 in debt. And above that, you can see that you've got two homes worth $1.5 million. So we work out the debt ratio of loan versus value of the property. And ideally, you want that to be under 80%. So here we can see that that's exactly what we're getting. The end debt is 78%. So that's terrific. That's the position you want to be in. This bottom example is your existing mortgage is higher. Say you owe $750 on your existing home loan and you're still trying to buy the little blue house for $500,000 plus all of the government fees. You're not using any cash. Now these two debts together equals $1,270,000. So now this is your debt, and up the top you've still got the two houses worth 1.5. Sadly, that ratio is over 80%. That is not the ideal situation. So that means you will incur a higher interest rate and lender's mortgage insurance. So I hope that helps you to understand the value of equity in your existing home and how it can help you buy more property without having to use cash deposit. If you're in any doubt and you want to know more about your own particular circumstances, pick up the phone and call one of us here at RD Finance Solutions. We look forward to speaking with you.